Well, good evening, ladies and gentlemen. Fantastic to see you here on this intermediate trader session. And notice many familiar faces here and some new ones too. So whether you've heard me bang on about stuff before or not, then you're very, very welcome to this. What is one of 4 intermediate traders clinics. This is the first, which is about trading plans. The second is about measuring trading performance. The third, we're going to do some psychology stuff. And the fourth, we're going to look at a trading development plan, so how to sort of plan your stuff going forward. So they happen once a month, and they're all 2 parts. So welcome to part 1 for this month. Again, for those of you who are less familiar with me as a speaker, then be prepared for a little bit of tough love. I'll tell you how it is. I won't soft soap it at all. And my aim is that you come away with something that's going to be useful, something that's going to be practical, actionable, and I'm here to support you as well. So any questions or comments at any time are very, very welcome. If you just let me know you can hear and see me okay. Good evening, Ian. Hi, Ross. Thank you, mate. And hi, Michael. G'day, David and Chris. Hope you've all had an interesting day. Now, I wouldn't normally do this on a session like this, but I am going to on this one. But before I do, I'm going to give you this disclaimer and this warning. Obviously, the opinions that are expressed are mine, not representative of your markets. It's my trading styles, my opinions on markets, my opinion on what you should have to put together. Now, those opinions are based on 20 years of experience in the markets and 13 or 14 years now teaching people like you how to trade various instruments. So it comes not only from my personal experiences, but vicariously from the experience of many, many other people as well, both in a one-on-one coaching context but also sort of in seminars, in workshops and that sort of thing. So that's where I'm at. Now, I just wanted to talk about the markets for about 3 minutes, okay? 2 or 3 minutes. Those of you who were on the inner circle last night will have heard me, and indeed the 2 live lunchtime sessions this week will have heard me sort of exercising or suggesting extreme caution is required because there was some inflation data coming out last night which had the potential to market move. Now, some of that was already priced in. The expectation was that those figures were going to be big, and markets don't like big inflation numbers, particularly earlier than was anticipated, because obviously that encourages central banks to take action. Now, these blew expectations out of the water. We're expecting a big number year on year because of where we were last April with pandemics. But even that inflated number was beaten significantly. More surprisingly, perhaps, was the jump in the month-on-month number, and this was not just food and energy, but across the board as well. So hence the market has spoken, and we'll just quickly look where things are. Here's the NASDAQ. I'll put it on a 30-minute chart just to see where we're at. So this was last night's. Let's start with the daily chart. So here we are. We're now approaching on the futures contract. We're now below where we were in Asian Open, and we're now 8% down from the highs, record highs we hit at the end of April there. Okay, if we look at what's happened over the last couple of days, so this is when that inflation data came out, and then we got some increase in bond yields after the auction, and closing at the lows of the session down, not quite as much as the Dow, but nevertheless down significantly, and is the underperformer of the indices this week. And this is all despite good earnings. So our cautionary note was justified, and I hope you took heed of that. Now, of course, there could have been a jump higher, and which we saw in the early part of Asian trading. Some of that would have been closing of short positions. Others would be optimism about it potentially moving higher again. But since, and we flatlined really within a fairly tight range right up until European Open. And this is European Open here. And you can see since then we've dropped, and we don't look as though we've stopped yet. So just to put it all in context about where things are. Now, of course, tonight we've got some jobs data. Tomorrow we've got some retail sales number out of the US. Both of those could fuel the flames. or calm fears, and then we could have some intervention from the Fed. So we'll have to wait and see what transpires over the next 2 to 3 days, but it does smack of being cautious. And this is one of the things that we need to bear in mind. I know we're talking trading plans today, but trading plans we execute, but we also have to take into account what we would term market intelligence or market awareness in terms of potentially how we execute those plans, or whether we execute them at all, or whether we step back. We can make judgments on risk in terms of position sizing, etc., at an intermediate and advanced level, which we've talked about before. So it doesn't mean you don't follow your plan. It just means you've got to make decisions about A, the level of risk you take, and B, whether you choose to step back or not because of the increased overall market uncertainty and risk. And we can sort of see that quite clearly in the VIX there, which is bounced up and down. We actually entered a position on that earlier on. But you can see, if we put this on the daily chart, there's the VIX in all its glory, and up in excess of 28% on the back of that. It looked as though it was going to drop down. In fact, this was the low where we were at the beginning of the Asian session, but we've crept back up again. So we'll just have to see what happens up until that jobs report, which is out in about 2.5 hours time. Okay, so that's a brief look at what's happening in the markets. Let's just quickly look at the US dollar index. You can see that's obviously gaining, and that's impacting on FX pairs, but very bouncy, very uncertain, and very difficult to find a trade that lasts more, that lasts any length of time. So nimble could be the way to trade it. Absolutely, Ian. And that doesn't. Ian suggested that it doesn't hurt to hear things a few times to help drum it in, and that goes whether you're experienced or fairly new. That unfortunately is the way of people. G'day, Shane. Is that they often take a few slaps from the market, a few market donations before messages get clearer. Anyway, I hope that's all good. I hope you didn't mind me doing that, but in extraordinary market circumstances, I just thought it was worthwhile doing that. Oh, okay, so that being covered, let's just look at what we're going to cover in this session. Now, remember, this is part one of a two-part session, and I will cover what we're going to cover next session later on. But in today, we're going to sort of explore, revise the nature of a trading plan and its importance in your overall trading systems, and what we mean by some of those definitions in terms of these sessions. We're going to highlight the key trading plan errors that people make, that I've seen time and time again, and what this means for you in your trading plan development. And also examine through providing examples the key components of a trading plan and their function in guiding trading action. Now, because I'm such an incredibly nice guy, what I've done is, if you look in the handouts, there is a PDF of a sample trading plan. Now, that was done for education purposes about 3 years ago now. So there are a few things that I would change if I was revising that, but it gives you a guideline, a sort of template type of thing, or an example of the way to put things together. And I'll reference that a little later, but I thought that would be useful for you today to take away and have a look at, because I know it is quite difficult to get things started sometimes, particularly when you're less experienced. So I hope that's useful. You're welcome. Now, I often start with this slide. I'm going to do it again. Is if we look at how trading results occur, we've got the market action and what's going on, and then of course we've got what happens in our mind. Okay, trading IQ, I call it. So we've got interpretation of that market action, and then application of developed systems, which means we've got to have developed the systems to be able to apply them, of course, and that requires learning. It requires some motivation, some follow through, and actually putting it together in a particular way. And of course, then we've got to make decisions based on that market interpretation and the systems to take action, and that creates results. So what we're focused on is obviously the middle part of this, although these developed systems are often in response to regular or frequent types of market action. So that's what we're trying to identify when we develop. Part of your plan is to trade various strategies that fit what may be happening in the market. And again, we'll sort of reference that later on. But just for context, that's it. So it does require some learning. It does require some psychological follow through, and that's why it's in that picture of the brain. Okay. And it's all about choice, because you have the power ultimately to make one of two choices. So you make choice one, which is you confidently and calmly develop consistency in your behavior when you're trading. And you've got a series of actions or criteria that can guide your trading decision making in a plan that ultimately you can test and amend to find the best system for you as an individual to manage risk and take profit on an ongoing basis. Okay, so that's choice one. That's what happens if you do the learning, the follow through, the hard yards in putting a plan together, the review of it, the measurement of it, the review of that measurement, and feeding it back in, etc. That's what choice one gives you. Choice two, on the other hand, which is where my guess is around about 65% of the trading population at least, and possibly even more than that. You'll have heard some figures banded around about 85% of traders don't make money, and that really is because they don't have a plan or a way of measuring through trading journals, which we're going to talk about at the next Intermediate Trader Clinic when I'm talking about measuring trading performance next month. And that took me all of 12 minutes to mention a journal, which is pretty good, really. But essentially, you've got to fall in one of these two categories. You either do or you don't. There's not try or not try, as Yoda would say. For those of you who, are Star Wars fans, yeah, there you go, Ross. You're absolutely right. But it's a choice. You either make the choice to do, or you take the other choice, which is to be driven by feelings, whims, and inconsistency with the decisions you make, and you have no ability to measure what you're doing and whether it works or not beyond a single trade. Okay, so which is going to serve you best for a lifetime of trading? I think it's pretty obvious, but yet still 65 to 75% of people don't have a written trading plan. I would guess that if I did a survey here, there would be a large portion of you who have either not got a trading plan at all, but more likely you've started one off but not exactly followed it through and created something that is really meaningful and actionable. What I'm going to try and do over the next two sessions is give you a little kickstart, or another sort of kick maybe, to say, look, this is what you have to do. If you are serious enough, if you are committed to being the trader you can be, choice one is where you've got to be. Okay. Now, as I said, many of you, and I know many of you, good on you, Stuart. That's the first stage. The first stage is owning where you're at. What matters is not what you've done today, whether you've got a plan or not right now, is just what you've done in the past. Okay. What matters is what you do from here. Okay. That's really where I'm at as a teacher and where I hope you are as an attendee of this session. So just some important considerations about your plan. First of all, is really take it down to where we're at. Okay, there's not a textbook on the planet that says don't develop a trading plan. Not one. I've never seen one. They all say have a plan, have a plan, have a plan. Any experienced traders have a plan, have a plan. So what we need to do, and that was one of the reasons why I put up that how trading results occur, is we really need to put the work in achieving what we can, putting the right things in place, improving sustainable positive results. And in meeting this challenge, there arguably is no more important system than your trading plan, because that is your guiding light for taking trading action. It should be your guiding light for taking action, as we've already sort of referenced. Now, it should be comprehensive and it should be evidence-based. We're going to talk about how to develop that going forward, because it may be that you've got something that's nearly there, but maybe there's a couple of gaps, or it may be something that's, and usually those gaps are relating to exit, interestingly, or it's not evidence-based in that it isn't your plan yet. It's maybe one you pulled off the shelf. I heard someone talk about on a webinar, because that has been one of the series we've run over recently. We've looked at different strategies, but you haven't done that refining, that measuring and feeding it back in terms of what works for you and your style of trading. Because the individual nature of being a trader, how you look at the market, the timeframes you trade, the vehicles you trade, are all very different. And we need to take that individuality into account when we refine plans going on down the line. So assuming you're in the position where you've already got a plan, Now you should be looking to the next step, which is how to refine that. And when we talk about trading performance next month, we're going to invest quite a lot of time on that, although we will cover some of that on the next session. And I'll talk about what we're going to cover later. And of course, performance of a plan will always differ on the unique set of market circumstances at every time. Some of the trades are going to go with you, some of the trades aren't going to go with you. That we know, okay? But also there's that overall market conditions that some particular plans or some particular strategies will work well in and others will not work well in. There may be some instruments which work well. Obviously, if you're going short the Nasdaq at the moment, that's performing very well. But if you're trading the Aussie Kiwi, it's not going very far. So part of it, and why I said it at the beginning is if we look at the three intelligences, it's market IQ, it's systems IQ, which is developing systems that work for you, and then of course there's decision-making IQ, which takes into account all the psychology, etc., which is session 3. So what we've got to do is combine that system with our interpretation of the market, and of course, as you sit here with your cup of coffee in your hand, or maybe a glass of wine at the end of the day, one of the judgments you've got to make is, well, look, Mike's talked about all this stuff. What's the first thing I need to work on? If you haven't got a plan at all, of course, it's to get things started. If you have got a plan, maybe there's a couple of things about statements being specific and measurable that we're going to talk about later that could be right for you. So you need to identify, as I'm talking through this process, both in this session and the session next Tuesday, about what is next for me in terms of my priority in developing the trading plan I need to develop. So that being said, let's put it all into, again, I really think it's important to keep on putting it in the bigger context, okay? So there's 4 key systems as a trader, and it's why I refer to as a trading plan or a trading system, generally speaking, because there are many systems. So this is where we're at now. So your primary trading plan, the strategies that go to make up that. And within that, we've got 3 subsystems. We've got how we enter, how we manage capital risk through initial stops and position sizing, and how we manage profit risk, or in other words, how we take a maximum profit. Then we've got our behavioral systems, which are all to do with the psychology of trading, or trader IQ, as I call it. Then we've got measuring systems, which really we're going to focus on next month, as we say. And then we've got some of this intervention systems we're going to talk about next time. So it's when you start to trade this plan, this primary trading plan you've got and the strategies within it, then we can start to refine that plan based on what we find in the measuring systems. So again, we're going to talk about that later in terms of how do I add new indicators, how do I add new strategies. I'm going to give you how-to lists for how you can do that, if that would be useful next time we meet. For those of you at that level. If you're not quite at that level yet, if the priority is to really finish off your primary plan, then that's fine too. But what I'll do is I'll create some handouts as well next time that you can have for future reference as well, when it's the right time for you to look at that. Now, as I said, one of the advantages I have is, or one of the advantages that you have even, is that you're not only getting my experience, but you're getting the vicarious experience, or you're getting the experience of many, many, many others vicariously who are in exactly your place. And I tried to sort of boil it down into what errors people made with trading plans, and almost use that as making sure that I covered that within these 2 sessions. So if we look at those who have got a partial plan, what I've often seen is they have an entry bias. So they've got some entry indicators slapped down. It may not be in a particularly specific format, but they've got some things down there, but really very little in the exits column. Okay, so that's error 1. Error 2 is they exclude issues of position sizing, time frames, how to manage economic data, the maximum number of positions you should have open, the maximum market exposure you should have as well. All of those should be in your trading plan. They're not within each individual strategy, but more so in almost an underlying rules of the game, your code of conduct for how you trade. And we're going to talk about that a little later too, and you'll see how that all fits in with this trading plan thing. Again, with those who have actually developed plans, have got statements that are ambiguous and not specific enough to enable consistency in action nor measurability. Remember, I said right at the start, you've got a choice If you really want to be able to develop a plan which is right for you, you need to have statements which you can measure. You need to, and as well as that, you need to be able to follow them consistently. You can't make judgments on a system unless it's really specific. You do the same thing every time, and of course, you record what you're doing. Those are the key things you've got to do. Those are key actions you've got to take if you want to take your trading plan to the next level. And that sort of ties in with this issue of not being evidence-based in terms of what works for you and doesn't as an individual trader. So that's error number 4. And then error number 5, again, which is going to be, as I've already referenced, is going to be something that we spend some time on, particularly in the next session. We've got no subsystems for the addition of new indicators, new strategies, or even taken away in some of the indicators, some of the pretty pictures that are on your charts. So all of those, there's a how-to list attached, and as I said, I'm going to give you those next week when we just spend a little more time on some of the detail stuff. And look, this invariably isn't people's fault. It's often because they haven't had access to the appropriate learning. Perhaps internally they haven't found, or they haven't created the sufficient motivation or commitment to trading to find the time to do this, and of course follow through. So all of these are very, very possible. There's no one on this session who can't address all of these, providing you have the will to do so, of course. So with those 5 errors covered, that's essentially what we're going to make sure that we cover over the next 2 sessions. So let's get into a little more detail into how we make plans happen. So first thing we've got to have is it's got to be comprehensive to cover all market decisions and behaviors relating to any trading idea. And by a trading idea, I mean the strategy you choose to adopt for entry. It's got to be specific with little unambiguity to promote consistency in action. Actually, that should be maximum unambiguity rather than little. So I'm going to just cross that out because that's going to upset me if I leave it there. So let's do that. There we go. So it's got to be specific with unambiguity to promote consistency in action and ability to measure. You've got to have the learning, the motivation, and the volition to follow through and make it happen, to engage in creating your plan to the level that will serve you well. And really importantly is you've got to have a belief in your plan to promote trading discipline in execution. If you look at the number 1 reason why people aren't disciplined in trading is because they don't believe in what they're doing. They either don't believe in their abilities as a trader, or they don't believe what the charts are telling them, or they don't believe in their trading system sufficiently to follow it. If you knew with certainty that your trading system ultimately will make you money, would you follow it? Yes or no? Of course you would. And so that belief in your plan is absolutely critical, and the only way to do that is through ongoing measurement and feeding that evidence back into it. Just get off this drawing mode. There we go. So on top of that, of course, there's subsystems for plan refinement. So those of you who have already heard me smash on about this sort of stuff before and are thinking, right, okay, I've got my plan now, what do I do next? Well, you need to have those subsystems to feedback evaluation into plan performance. So you can implement a new plan, allows you to add, take away components, parts of your plan, and add new strategies and associated strategies. So let's get on to what a plan looks like. And as I said, what I've done is I've done a little handout here, which you can take away, have a look at. But you see how I've just refined this structure a little bit, but you can obviously, it's there as an example that you can use to help you along the way. Some people put pictures in of what they mean, but we can talk about that later, perhaps next week. So I'm going to go through each of these in terms of what they may look like, and we're going to invest quite a little bit of time on the strategy outline because that's what most people focus on. So you start with a document outline and obviously have a trading purpose written in that. So what is the reason for your trading? What difference is it going to make, the choices it's going to potentially give you? I've already referenced this code of conduct or the key trading principles. These are underpinning statements, almost like a business has a vision or mission statement that says, this is how we're going to operate. Having that as part of your trading plan, and you'll see that, actually what I might do is I might just open this up so you can see what I'm talking to. So got a trading thought. So these are these broad trading practice principles. I'm going to talk about these in a little more detail yesterday, and I've done quite a few just to help you along the way. Okay. And then we've got strategy outlines. Now you need a separate page or a separate part of your plan for each different strategy. So let's say we've talked some of the strategies we've talked about over the last sort of couple of months in a circle, trend reversal, break. Actually, we haven't talked trend reversal for a long time, but breakout strategies, we've talked bounces, and we talked about sort of associated systems. We've talked about accumulation strategy, and we've talked last night about trading a trend continuation after a pause. So those would be individual strategies which would be referenced. Now, just in relation to this document, you can see I've essentially put one there, which is I've just called strategy name MA and volume. So that's looking at a combination of moving average and volume. Okay, so that really is a trend reversal strategy. So let's say we had a breakout strategy as well, then we would have that as the next line. You can see I developed this in 2018, so it is 3 years ago now. So as I said, there's a few things that I've tweaked since then in terms of my thinking to help you guys along the way. And that's one of the great things about educating, is that you that the feedback and the questions and the comments that I get from you guys go to further develop sort of materials that are going to sort of help not only you, but also other people going forward. So we're turning excellent into very excellent, if you know what I mean. Okay, so there we go. So that's what is in a plan. So it makes sense to just have a look at these in a little more detail. So your document outline and trading purpose is really a clear statement about why trading is important to you and the formalization of the plan document. Now, what I mean by that is give the document a title. So trading plan 4, Ross, date of development and formal review date. Okay, and what that does is it says, although it may seem petty, it is actually really quite important. This says this is an important business document. Okay, this is all about my trading business. You wouldn't start a house without a plan. You wouldn't. Best businesses tend to run when there's a business plan behind them that sort of suggests how they're going to operate and how they're going to manage risks and how they're going to take opportunities. Why should trading be any different? If you're trading it, if you've got that level of commitment and treating it seriously enough that you're hoping it's going to make a difference to your lifestyle going forward, then it should be treated as you would any business. So that's why I'm saying just formalize it a little bit, even though it might seem, oh, just it's Mike doing his thing. Do it. It's important from a psychological point of view. Then you have something about the purpose of the document. This is an ad. So you would have maybe a couple of lines that say the purpose of this document is to, or the purpose of a trading plan is possibly a couple of the things that I've already talked about there. So it's to guide my trading actions in the heat of the market. It's to encourage me to be consistent in those actions, and also to enable me to measure what I'm doing so I can refine my plan as an individual going forward. So what the purpose of the document is, and then your trading purpose. And there's a couple of fantastic examples of how I've seen of this from some of you guys, which I thought were wonderful. And it just talks about, generally speaking, if you boil it down, a trading purpose is what you're actually doing it for. You're doing it to replace income, or you're doing it for capital growth. You're going to take a lump sum out. So you're going to do the round the world trip, or are you going to pay the bills with it, or reduce the number of hours you work? What's your actual goal of doing this? And that's far more compelling and far more likely to create the seriousness, the commitment behind it, and feeling bad about being further away from it if you don't do what you're supposed to do, than simply making money. Another story for another day, and perhaps when we look on to go into psychology, we'll talk a little bit about the psychology of results and what that can mean and doesn't mean. So that's what I'd say. Now, there's elements of that in the document I've given you. So essentially, as we sort of look down, you can see there, that's a bit loose, okay? But you can choose one of those and then say what that looks like. What's it for? Is it to reduce? Is it to reduce work hours? Is it to pay bills? Is it to go on a around the world trip? What's it you're doing it for? Okay. So right. So that's the easy bit. Okay. But then we go on to the bits which are slightly you're going to have to think about a little bit more. And so underlying trading principles or key trading principles or your code of conduct, whatever you want to call it. What these are clear, specific statements about your behavior in the market and the key risk management parameters. So how are you going to manage things? So it can include statements about understanding, acknowledgement of risk, and of course, personal responsibility for actions. So things like, I know that I have control over everything in the market, everything I do in the market, apart from how a price moves, everything else I'm in control of. Therefore, I am responsible for my results. That's how you would take personal responsibility. It's not the interest rate's fault. It's not the Fed chairman's fault. It's not Scott Morrison's fault. It's that person. Stick that hand up in front of your face and look in that mirror. It's that person's responsibility, both good and bad. And before I think I've said this before, but my partner's in the horse world, okay, and it's an interesting and unusual place. And one thing I've noticed over as a glorified stable boy, not someone who participates apart from being supportive, is that with things like show jumping and stuff, if something, or cross country, if something goes really well, then it's the rider's work that's created that. If it doesn't go really well, it's usually the horse's fault. The horse hasn't behaved, okay? And I've heard that time and time again, and it makes me smile, because that's exactly how a lot of traders behave. If they do well, it's what a great damn trader I am. Start sort of wearing Mr. Invincible uniforms and wearing a cape, and you're a super trader. If it doesn't go well, then it's something else's fault. It's the education I got or didn't get. It's the market's fault. It's the government's fault. It's Donald Trump and his tweets. Whatever it is. So that's just, you are in control, and again, we'll talk about that. We'll talk psychology. But also in this, you should have things like the maximum number of trades you can have open at any one time. How are you going to use margin? Obviously, the margin rules have changed, and that's going to be dependent on where you are as an account holder. Primary timeframes, perhaps, that you're going to trade, and also what your standard approach with economic events are going to be. So really, there's three choices with that. Invariably, people choose to either just use their existing stop system. Some people might choose to trail a stop. Other people might choose to exit if they're already in trades. Invariably, if you're thinking about getting into a trade, you usually don't do that prior to an economic announcement. So usually those things are written down. Now, some example statements of here. Just I'm not going to go into great detail about this because I want to get onto other stuff. And secondly, it's there in that document anyway. No, absolutely, I didn't say that to her about the horse riders. No, I'd get hung, drawn, and quartered. But it's the truth. That's the other thing about horse people. They don't like to hear how it is sometimes. Anyway, enough of that. So you can see here, these are essentially statements of intent, okay, which is another way of, and why I call it a code of conduct. And in each of these, I would suggest are important, irrespective of what vehicle, what time frame you're trading, and what strategies you're using. So have a look at those that are in that downloadable trading plan, and make a decision and put them in your own language. It's always great if you put these things in your own language so they become yours. You have ownership. It's not just some stuff that I downloaded from Mike's session, but make it yours. Put your mark on it. Write them in your language. The mind of Mike is a strange and interesting place sometimes. And the way I articulate things, it may not necessarily be the way that you do. So put your own spin on it. And of course, you can decide which are relevant for you, which aren't, and of course, add your own as well. So go have a look at that. Now we're getting on to the bit which most people think about trading plans, but now we've done all of that stuff, then we're going to move on to strategy. So when we talk specific strategy outlines, what our aim is, as I've said before, and I'll say it again till I'm blue in the face, is we're looking for consistency from trading idea through entry to exit on every trade, okay, for that particular strategy. We need a separate outline for each strategy because what we're trying to do is we're trying to take advantage of different types of market movement. So, for example, let's just smash over to charts, and it gives us an opportunity also just to have a look at how things are going. So if we looked at this VIX chart, for example, we'd see that there is a line in the sand right there at 25.43, okay, on the daily chart. We can also see on the hourly chart that has had a few attempts to break through it. So there's two things that could happen here. So it could break out there and continue to go higher, or it could bounce off this, come down here, and form, whoops, let's just change the pen color. Let's choose yellow. So it could come down here and form a double top. And away we go, downwards. Or very downwards. I didn't mean to do that extra line, but we improvised there. Okay, so there's a couple of strategies that we would need to have in place. If we wanted to trade breakouts, we'd have to have a breakout strategy here. If we wanted to trade a bounce, we'd have to have a bounce strategy that played this game, based on what market moves, or those 6 ways of market moves that I've talked about before. If we're interested in, let's just get rid of these drawings, just so we've got some clarity. Right, okay, let's just, so here, this is interesting. So we saw this possible key level here. You can see if we put it on the line chart, it was important here, it was support here, and now we've smashed through it. So we could have traded that if we had a breakout strategy. We could have traded this reversal here if we had a trend reversal strategy. But if we don't have a trend reversal strategy, we can't trade a trend reversal because that doesn't fit with our plan. If we haven't got a breakout strategy, then we shouldn't be trading breakouts. So what we need to do is we need to do it step by step, plan for this, a plan for this, and a plan for that bounce we saw off the VIX, if indeed it does that. So that's the idea, just to sort of reinforce it in terms, and also gives a chance to have a look at the market again. So it would have things like specific statements relating, give it a name, give the strategy a name. When I was doing a lot of options education in the US, I had one called Jaws and one called the Barracuda, and just give them a name that's going to be memorable, okay? Or you can just say it's an MA volume strategy, as you can see on that downloadable plan. So you need to have entry criteria, both technical and fundamental. So the fundamental aspects, usually with short-term trading, is of course what's happening re economic data, or if you trade share CFDs, if there's earnings or dividends due. And of course, but there is a strategy which is all about trading that long-term idea, which is primarily fundamentally based. And you'll have heard me bang on about copper before. Copper's actually just sort of upset me a little bit at the moment because it's not doing what I want it to do, but that's okay. But you can see you can trade this now on Go Markets platforms. How good is that? So here we have copper potential short. You know, you can only trade that, of course, if you've got a breakout strategy on the hourly chart. If you want to trade it on the daily chart, there ain't much data going on, but you can see how it could be a trend reversal on the daily chart for right now. It's still at decade highs, okay? So this is only a minor pullback for right now, but you can see there is a breakthrough. Ever since the European market opened, it's dropped off as well. Actually, interestingly, off its lows. We'll see what happens with this next. But again, another excuse to have a quick look at the markets. And of course, after your entry criteria, you've got stop loss criteria, profit target criteria, and your trail stop system. And we're going to sort of discuss a lot of that next week, of course, when we look at this in more detail. But just to give an example, for those of you who haven't seen this before, As I said, for consistency and measurement, we're wanting unambiguity. So if we consider this statement, I'll take a long trade if the price breaks through an identified line of resistance with increased volume. Now, on the surface, that's actually not bad. It's got the right sort of components in, or around and about the right components. And of course, it's far, far better than having no statement in at all. But that's something I've seen quite frequently. But there are problems with that in terms of being absolutely specific and consistent and measurable. We haven't defined what we mean by a breakthrough. We haven't suggested when in terms of your time frame. So you're going to do it at the end of the candle, anytime during the candle, or after the candle that said it's actually broken through, and increased volume compared to what. So this is the level of unambiguity that you actually need in terms of your strategy statements. So if we look at our 4 primary key entry approaches, again, we've sort of talked about this before. We've got trend reversal, breakout, bounce strategies, and of course that long-term trading idea. And those 2 secondary approaches, accumulation and trend continuation. Now, we covered this in last night's Inner Circle. If you couldn't make it along, want the recording, drop me an email, and I'll flick you the recording through of that. So what we need to do is we need to pick a strategy, or we need to develop a strategy for each of these. And also these, if we're going to add them to the game as well. Sorry, I just muted myself there for a moment. So if you're starting out, obviously it depends where you are. If you're starting out, then obviously you need to pick one of these. And I would suggest that breakout's a really, really good place to start. It's really simple. In terms of making sense of it, there's not with making a plan that's actually really, really sort of specific and in terms of criteria that you use. And it can be used as part of some of the other strategies. So once you've got that breakout done, that's good. And of course, we've done that before. Or a trend reversal, that's, as I said, an MA cross, that's an MA volume type of strategy that you've got in that, that download. So each of those merits a separate strategy. So where do you start? Well, look, the first place we start is what's the anatomy of the price move you're looking to trade. So as I said, what do we mean by a breakout? So we want 3 or more touches of a particular price level. We want it perhaps half an ATR above that resistance line or below that support line to say it has actually broken through, and we want it on the close of the candle, and we want it in the top third if we're going long, bottom third if we're going short. Okay. So what we've done is not only said, well, look, that's what it looks like on a chart, but also the additional clues that we could use to create higher probability entries. And then we're going to talk about this in more detail next week when we look at adding new strategies. There's an 8-point checklist I've got, which could be useful to you. But then we can, one of those is, are there additional considerations specific to this strategy? And it would be rare that that would be the case, but perhaps that would be, we would perhaps not trade a, we would not trade a long trade on a share CFD if the VIX is going up or the underlying index is going down. So there may be other things we take into account, other criteria that we add, or there's earnings due that are specific to that particular instrument. Or time frame that we're trading. And of course, then we've got to say, well, what will our exit strategy look like? Just quickly having a look. If you can send me a copy of last night's Inner Circle. Alan, could I ask you a favor? Because it's really quite difficult for me to extract info from this. I'm more than happy to do that. But if you can just drop me a line, Alan, to that email address I've just put in chat, that mike.smith@gomarcus.com. Be absolutely delighted to do that for you, mate. Okay, all good. Right, so that, if you like, is your ABC of what you do. So let's look at what last night's session, what we talked about. So we talked about technical rules for a trend continuation, technical rules to produce a higher probability entry. And so we said that really if we look at the anatomy of a trend continuation, so if we look here, there's a little pullback here, a little pullback here, and then we get a move higher again. And so what we're wanting to pick up, it doesn't matter what we're looking at, it's going to be the same deal. Let's look at a 15-minute. Let's look at a 15-minute USD, Japanese yen, trend continue. There's the retracement, there's the continuation, there's the retrace, the pause, trend pause, there's a continuation. So what we're looking for is a break of that pivot high. We're looking for a candle in the top third. We're looking for increased volume, which I think there was on that candle actually. No, there wasn't. And also, we also talked about the danger of trend continuation being you're actually in an overbought situation. So let's just slap an RSI on this. There we go. At that stage there would be overbought, so we wouldn't touch that if it's part of our plan, of course. If it's not part of your plan, you don't. So let's just look at the Aussie US. Okay, so we had a trend pause here on the way down on a 1-minute chart. Okay, it doesn't matter what time frame we're trading at. There's our candle of interest. So bottom third, below that pivot low, there is our increased volume. There we trade it downwards. Okay, use a 10 EMA perhaps as a stop on that. So we're just snagging a few pips on that, maybe 10 pips on that 1-minute chart. If indeed you're trading 1-minute charts, and if you do, you're very brave. But what I'm trying to get over is that often it doesn't matter if we're looking at time, what irrespective time frame or instrument. So if we look at this Aussie US daily chart, then again, we can sort of see here, we had an uptrend started down here. We had what looked like a flag formation, and then we had this break above a pivot high there, top third of the candle. So we could have traded that on the daily chart. If again, the RSI wasn't too hot, which again, it could look like it maybe is. Put it on a check. Actually, it is too hot. So we would have left that one alone, and that's good. Let's find one that isn't in that place. Let's find let's do the NASDAQ on an hourly chart. Okay, so we've got a new trend starting here. I just wanted to give you this so you get it. So let's say we're trading, there's the new trend started, there's the retracement, there's the break of the pivot low, and there's trend continuation, okay? I'm pretty sure that that's not oversold. And also, just take care of the pivot high that it's retraced to. That's going to be an important point for what we're going to talk about next. Okay. Okay, so as a quick revision, for those of you who are there, I hope that's useful. For those of you who weren't there, I hope that's useful. But I just want to keep it real in terms of showing you it actually. So what we're doing is the price close in the top third of the candle above the pivot high. Now, whether you add an ATR or not, or you can just have a close above the pivot high if you're long, below the pivot low if you're short, and increasing volume. So all we're saying with that is increasing volume. Actually, I should have made that more specific. Now that's that should resolve it. Okay, so we want a higher volume than the previous bar. Okay, so now we've got a plan, and then because of that, it's continuation of trend. We always would say greater than 1-to-1 risk reward, but if you've got a profit target there, and it's worth considering the RSI if you do trend continuation. You may not have that as it's unlikely to be, if you trade trend reversal or breakout trade, it's very, very unlikely to be in an overbought or oversold situation just because of the way the market moves in those situations. but with trend continuation, it is a potential risk. So that's worth adding to the game. So look, I hope that can you hear me okay? Let me know all is good. Oh, okay, very cool. Yes, I think I just muted myself temporarily there. I hope you heard everything there. So that essentially is your criteria for entry. You can see it's indisputable. Okay, it's absolutely unambiguous. There's no way you can't trade. You can say that that is not going to happen. Thanks, Colin. There's no guesswork involved in that at all. All you're doing is you're identifying a previous pivot high. Now, if you want to, you can state that it's the top, it's the high of that candle that was the previous high, not the candle body. It might be that you choose the candle body and you do half an ATR, whatever's right for you. But what we do is we plant our flag in a strategy and we trade it religiously. And if we trade it religiously and measure what we're doing, then of course, once we've got a critical mass of trades, we can say, well, what would have happened if I had just made it not 0.5 ATR above, that I just made it above the top? If it had closed above the wick of that previous pivot high, or if I'm trading short below that pivot low, if I'd done that, what would the difference have been? But you can only do that. You can only start a system test, and we're going to do this next week on Tuesday. We'll give you a how-to list of all of this sort of stuff. We can only do this if we've got a plan that we can be consistent with, and we measure what we're doing. If you don't do that, if you're not consistent and you don't measure what we're doing, how will you know? How will you know whether 0.5 ATR or just above a pivot high is a good place to go? You won't. It's really that. You're using the force or some of the natural power for my second Star Wars reference of the evening so far. Okay, so I hope that sort of makes sense. But that isn't rocket science, is it? But it requires a process to get to that place. Now, if you're in the stage of plan development for the first time, I wouldn't suggest you start with trend continuation. But the nice thing is that if you've done breakout, as I've said, there's a lot of similarities between this and breakout. If you've done a good breakout plan, a lot of these are the same. For those of you who've heard me bang on about breakouts before, you'll see what I mean. Interestingly, trend reversal, if you're using chart patterns, a lot of these things are the same. So once you get a plan and it starts to work for you, then you can start to do one strategy first and then add the others as you go. And exits considerations, because it's all about exits really, isn't it? So we could use your previous pivot high if we're going short, as we showed you on that chart there. So if we're entering on this candle here, then we use this pivot high at the last retracement as potentially a stop level. Now again, you can put it on that level, or you can put it maybe half an ATR above it just to take out the wick noise thing. But the reason we do this, if you think about this, okay, so just let's put it on a line chart for a second. Might try and find a better example than this. Let's do it on a scroll off. Okay, so yeah, let's try this. I hope I get it across, but let's just try here. So here's our retracement. So our trend starts here, and there's our retracement, okay? And then we go down. Now, if it doesn't break, or if it just breaks that pivot high and we get in, but then bounces, what have you got? You've got a double bottom formation. So it's a trend reversal pattern. So that's why we put a stop just around there. If we look at an uptrend, we're not going to get an uptrend on Zoom. Okay, if we're looking at an uptrend, let's look at this one here. Let's look at in some detail. Again, let's just knock the scroll off. So here we are. So there's our uptrend. There's our trend pause, and then we continue. This might be the candle here that we get in on. Okay, that one there. Maybe even the one before that, because it's got high volume. It's in the top third. So, okay, let's say we're getting on that one. And then it drops again to where this pivot low is of the retracement. So once again, we get a reversal pattern. We get a double top formation, okay, to fill in the gaps. So that's why we would put our stop there, or use that as a reference point perhaps. So that's the logic behind that, okay? I like logic. I like simple, and I like logic. Okay, so if you want to, again, you can either choose to use any price below, so it could be 1 pip or 1 cent below the wick, or maybe half an ATR below the body of the pivot low, or pivot high. Whatever's right for you. You plant your flag in something, and then you consistently trade and then test the alternative. And then that should be, I'm not sure what happened there, but we'll put a point there. So profit target 0.5 ATR below next resistance, and trail stop using the 20 EMA. Now I'll show you next week. Next time we meet, we'll talk a bit more about trail stops and exits and stuff. But there we go. We've got an exit plan. So we've got a breakthrough a previous pivot high or pivot low. We might have that or might not have that. We have a profit target, and we have a trail stop. Tick, tick, tick. All very, very tradable. All absolutely allow consistency in measurement. So again, have a look at let's see. So as I said, this is 3 years ago, so may well. So there we go. Initial stop. Okay, so it's set at 1.5 ATR below. Entry price. I no longer like that as a statement, that bit there. So I'm going to cross that out if I was to do it now. Or was there a profit taker? Again, this should be 0.5 ATR below. So I'm now critiquing this thing developed 3 years ago. And we don't like pips anymore. We're going to use 20 ATR. Okay. So again, just to sort of, left this. I was going to develop a new one. I thought, no, I'll leave this because it gives me a chance to show how you will critique something that perhaps has been in place for a long time. Okay, so with that, we're going to add 0.5 ATR. Okay, with this, okay, that's cool. But with this, we're going to use either the 20 EMA, and then I'll show you an alternative if it really starts to move up. And of course, this doesn't work also if we're trading share CFDs or indices, pips don't work. So maybe you tighten it to a 10 EMA. Okay. Okay, so there's a little critique of that. Okay, which makes it more specific. Again, I hope that's useful, actually seeing what we're doing on something that's a document there. Let's just get rid of that. Let's just get back here. Let's just get back on normal mode. Okay, so that's really it for this time. So I hope you've downloaded the plan. Please feel free to email with anything you need. There's a couple of you made reference to things that you'd like. Just drop me a little line to remind me, and then I'm more likely to remember. Next time, what we're going to do is provide, as we did with the trend continuation, I'll provide a little more detail and show you how, once you develop one, it's not that hard to develop some of the others regarding the 4 key trading strategies with obviously the long-term trading idea based on fundamental fundamental concepts is slightly different to a technical entry. But we'll also explore the principles and practice of how to develop an evidence-based plan that fits you as an individual trader. So part of that is looking at refining in the indicators we're using for decision making, so perhaps changing the parameters or adding new indicators, taking indicators away, and of course adding new strategies. So don't miss it on Tuesday. Thank you very much for all your participation tonight. Your questions and comments have been great. Fantastic, Alyssa. Yeah, look, what I would say is really, Fred, you're welcome. Just a quick look. Pierre, you're very welcome. Great to see you here. Mark, you're welcome. Thanks, Ross. Cheers, Dave. So really, what I really want you to do is don't beat yourself up about this. If you've not got to the stage where you've got a trading and plan developed, I hope this has just helped move you on a little bit. And even if you're welcome, Ian, thanks, Shane. Even if you're sort of already developed a plan, I hope it's given you a few pointers in terms of how to refine it to make it serve you better. So that's it for me for now. Take care of yourselves, trade safe. Please just be careful of these markets in the next couple of days. They could be choppy all over the shop. Remember, we've got some jobs data, we've got some retail sales data tomorrow as well. We've got a market which is debating whether that's enough for right now or whether it's all priced in. So it could be nimble is the key, and of course risk management as always. So take care of yourselves. Have a wonderful weekend. We'll catch you on Tuesday. You're welcome, Eric. Look, it's all good. David, again, that's great owning where you are right now. And as I said, it doesn't matter where you are right now at the beginning of this session. What matters is what you do now. So good luck. I'm here if you need me, and we'll catch you again very soon. Bye-bye for now.